G'day guys, welcome back to the Devin Too Good Investing channel. In this video today, we're going to be having a deep look into Dropbox Stock, ticker symbol DBX, and we're going to be looking at whether it is a good buy or whether you should be selling the stock. For full disclosure, I do own Dropbox Stock and I have owned it since about January this year, particularly when the stock did fall quite a bit, and I picked up and built out my position, but I thought I should just let you know before I go into my thesis. So when it comes to Dropbox and my bullish thesis, there are 6 main points that really make me quite bullish about this company moving forward. The first one's the consistent recurring revenue. The second one's the paying user growth and growing ARPU, which is annual revenue per user. Then we've got the facts that Dropbox is a essential business because 80% of Dropbox users actually use it for work. Dropbox has minimal customer concentration, which means if they lose a customer for any reason, it's not going to have too much of an impact on their business. They have margin expansion by growing their ARPU and reducing costs. And then point 6 is that the company are guiding $1 billion in annual free cash flow by 2024. And right now, this company is currently trading at $12.9 billion. So if you kind of do the math there and we assume sort of the 23 cash flow multiple, that could potentially mean the business in 2024 will be worth approximately $20 billion. Currently today, Dropbox is trading at $32.39 per share on the NASDAQ. And where I built out my position was around January time, in and around sort of $21, $22. I did think Dropbox was a good deal around this $20 mark back in November. However, I was still doing my research back then and I felt comfortable buying it in this area around here. And since then, it's run up roughly 30%, all the way up to $32. So Dropbox offers a cloud ecosystem where you can get basic plus or professional packages, either for your family, just a standard one. You can get an advanced package, or probably most importantly for this business is the enterprise packages. But to strengthen this ecosystem, Dropbox also have HelloSign, which is the e-signing of documents, and they also have DocSend, which pretty much just makes the ecosystem better. And what we're finding is ever since Dropbox added the additions of HelloSign and DocSend, the ARPU has been increasing, and it's also been improving the Dropbox ecosystem and making the products more sticky. And as a result, this has led to better recurring revenues, and it's also led to margin expansion, as we'll see later when we have a look at their free cash flow growth. Another big bonus about Dropbox is their huge user base. So currently they've got 7 million plus registered users, and about 16.14 million of them are paying. And as we discussed before, Dropbox is pretty much an essential business for a lot of people, where 80% of subscribers use Dropbox for work. Now, some people might see this as a negative, where they've got 700 million free users, or you call them just registered users, and then they've got 16 mil paying. So that's quite a small percentage of the 700 million that are actually paying for the products. But you could also see this as a huge opportunity where Dropbox can really try to convert these free users into paying users over time. So Drew Houston is Dropbox's current CEO, and he's always been CEO. He founded the company, and what's really nice is that he owns 10.3 million shares, or $338 million worth of Dropbox stock. And this is really great if you own Dropbox shares, because if the business does well over the long term, Drew Houston will also do well over the long term, and so will shareholders. So it's really good when the CEO and the management team are aligned with shareholder values. Now, what we're looking at here is Dropbox's long-term targets. So their long-term targets, they're aiming to hit all these values here by 2024. And you can see that their gross margin is already in their long-term target range of 78 to 80%. As in 2020, it was already at 79%. We can also see over time that Dropbox are going to be decreasing their R&D expense as a percentage of revenue, and they're going to look to bring this down to 23 to 25%. This should lead to margin expansion on the bottom line. We can also see S&M expenses dropping down over time between 18 and 20%, and also G&A expenses dropping down over time to 8 to 10%. And as a result of R&D expenses, S&M expenses, and G&A expenses decreasing through to the long-term target at 2024, we will see quite significant operating margin expansion. And we can see it actually jumped from 12% through to 21% in 2020. And by 2024, it's expected to be between 28 and 30%. And as a result, this is going to lead to quite significant free cash flow growth, where by the end of 2024, we're expecting at least $1 billion of free cash flow. And what is also quite good is that in the past, management's estimations have been quite conservative, and you can see that pretty much every quarter they do beat their annual revenue guidance, or at least the analyst guidance, and also they beat EPS except for this one quarter back in Q3 of 2018. And what's really nice about this is that when we go back and look at their long-term targets, Dropbox is not known for making crazy predictions that they can't meet. The fact that they're making these long-term targets here is they're probably being quite conservative about it, which does give me more confidence as an investor. If we look here at some of Dropbox's key metrics, you can see that their revenue has been steadily and quite consistently growing over time, where it's estimated that Dropbox will do $2.1 billion in revenue. And we can also see that the company is guiding $720 million in free cash flow. Gross margins, we're looking at 80% end of year, which is well within their 2024 long-term targets. And then also operating margin of 28.8%. We can see that's probably due to decreased expenses. And we can see this is also going to travel down to our free cash flow of $720 million. What is also really important is this annual recurring revenue number. This is growing, and it's over $2 billion now. And with addition to that, we see paying users continue to chug along each and every year. And finally, ARPU. This number is also growing year after year, and this is going to probably continue to keep growing due to HelloSign and DocSend. These products are more expensive than Dropbox's traditional products, and this is going to continue to drive the ARPU. And at the end of the day, all this revenue number up here is pretty much the paying users times the ARPU. And that's how we get that revenue right there. So if you really want to know how well Dropbox is performing, all you really want to focus on, if we're going to break it down to something as simple as possible, is the paying users growth and then ARPU growth, because then that leads to revenue. And if the company's still decreasing expenses with their margins and expanding their margins, that will eventually lead to that free cash flow that we ultimately want. So we can see here that HelloSign, the e-document signing platform that Dropbox have created, it is more expensive than their traditional products, and you can see that they have products ranging from $15 to $25 to $40 per user per month. Or if you want the API, you can see you can pay all the way up to $400, and this is probably what big corporations will be paying per month. And then we also have good old DocSend, and we can see here, if you get those enterprises on board, they're paying, their plans start at $5,000, but even single sort of users, personal users, they're paying $10, $15 a month. Or if you want the standard sort of business one, you're paying $45 to $65, and the advanced package, which includes 3 users, it's like $150 to $250, and this might be the sort of platform that possibly small businesses with only a few employees, this is the one that they'll probably look to buy. For me, another really fundamental part of the Dropbox thesis is their share repurchase program. So we can see back in February, Dropbox decided to repurchase $600 million of the company's outstanding shares. And then what's really nice is that in February 2021, they were authorized to repurchase an additional $1 billion of the outstanding shares. So then during the 3 and 6 months ended June 30th, 2021, the company repurchased and subsequently retired 5.5 million shares and 24.1 million shares of its Class A common stock for an aggregate amount of 150.8 million and $582.7 million respectively. So guys, now that we've looked into the bullish thesis of Dropbox stock, let's now do a intrinsic valuation using a free cash flow method. So for this valuation, we'll be using the 2020 free cash flow of Dropbox of $574 million. And then for year 1, 2021, this is based off company guidance. I'm going to be using $720 million. And then for every year going out to 2025, I'm going to use growth rates, as we can see here, of 12% down through to 16%. So we're going to be targeting a rate of return of 22%. And I've also inputted in the shares outstanding. So this takes into account the buybacks that are going to occur over the next, all the way through to 2024. This is my prediction. And I think Dropbox are going to have 376 million shares outstanding. And if we incorporate a 20 free cash flow multiple for Dropbox, we will see that we have buy prices of between $25 and $28, assuming these levels of growth. And I feel quite comfortable, as you can see here. Remember how Dropbox promised 1 billion plus of free cash flow by 2024? I've made my models so that it leads to this outcome. And I feel comfortable for any of these models pretty much. In particular, models 1 to 3, I feel like they're fairly safe. So a current buy price of $24.94 all the way through to $26.50 is pretty good, as long as you believe in my thesis and the fundamentals of the company are strong. So pretty much Dropbox will have to fall 18.18% for it to hit our 22% return. We can have a play around with this. If I go back to the discounted cash flow now, and I change our rate of return to, let's say, 18%. Now let's make it 17%. So this takes us roughly to the current share price. So if you were to buy Dropbox shares today, you could roughly expect a 17% per year return. However, I like to target this 22% per year return, as it provides a nice margin of safety. Anyway, guys, I hope you enjoyed this video and my analysis of Dropbox. I will not be buying any more Dropbox. I've already got a position established. However, if it does drop down to this $26 sort of level, that's when I'll become interested again and probably top up my position. Please subscribe. Please like this video. Have a good one.